With interest rates at the highest levels that they've been in 20 years, and inflation at the highest levels that we've seen since the 1980s, I think it's a fair question to ask, does raising interest rates actually impact and lower inflation? Economics comes down to supply and demand. Since most purchasers of big ticket items such as boats and cars and homes are also borrowers, when you raise the interest rates, that also affects the demand for those products. Another factor that affects demand is also what you call the wealth effect. As interest rates rise, that also typically has a negative impact on the stock market. As people's stock portfolios and 401ks are worth less, they also have experienced kind of that wealth effect, and they're likely to borrow less as a result. So here's the challenges when it comes to the strategy of raising interest rates to decrease inflation. Number one is housing is factored into inflation. In fact, it's the largest expense for most Americans, whether it be your mortgage or your rent. So as rates increase, so do mortgages and also rents. For example, a $300,000 loan at 30 years and 3% was $1,265 a month. Compare that to 7%, that is now a $1,996 a month payment, which is a 58% increase. So not only do mortgages rise during periods of high interest rates, but it also helps justify raising rents as well, because rents need to be somewhat in line with mortgages to help make that balanced. The other challenge to this is that there's two parts to economics. There's both supply and demand. As you raise interest rates, that artificially manipulates the demand for housing in the economy. So as interest rates rise, demand shrinks. But as interest rates shrink again, you're going to have that demand get elevated once again. And since we still have a supply imbalance in the economy, we're not fixing that. We're actually making it worse. We have a 5.5 million home deficit, but we're making it worse by raising interest rates. And the reason we're making it worse, or how we're making it worse, is that we're scaring off builders from building new construction. And so they're actually slowing down with these heightened interest rates. So the next time that we come around in the next year or two, as interest rates fall again, we're going to have a more possibly extreme imbalance on supply and demand. We're going to have that demand once again with lower interest rates, and then supply may be even more imbalanced with less homes being built. With the Fed artificially manipulating the demand in this country, but not affecting the main source of challenge, which is that 5.5 million home deficit, which is the supply equation of economics, you may have seen this meme come across Twitter. So what is my recommendation for you? If you can buy a home in this market, take advantage of these more favorable buyer conditions, because we're not likely to experience that as interest rates start to decrease again. So take advantage of the more favorable buyer conditions, and then look to refinance as rates go back down.